Hey, what's up, guys? It's Jonathan here. So, we just got the ADP employment report numbers today for the month of November, and it seems like Santa came early this year. So, let's get into the details of this and kind of break this whole report down. So, to give you some background on this, this is a report of private sector employment that ADP has access to. So, for those of you who don't know, ADP, they're a payroll processing company. They usually work with bigger firms, but they also work with smaller firms as well. And they aggregate a lot of the data that they're purview to. So a lot of these companies, when they let people go or they increase wages and stuff like that, ADP has access to all the data. And usually it comes out a couple of days before we get the official data from the government, which is called a JOLTS report. We did cover last month's JOLTS report, and I do plan to cover the one that's going to come out on Friday, I believe. So stay tuned for that. And most of the time, this employment report is on par with that report, but that's not always the case. So we're going to have to see what kind of numbers we get on Friday. But, anyways, let's just focus on this report for now. So the top line number was that the private sector added about 127,000 jobs in November, which was the slowest growth that we've seen for jobs month over month since January of 2021. And the estimates were about 200,000 for this month. So this is a good sign to see these numbers down from the estimates that we had. When it comes to annual pay, it's currently up about 7.6% year over year, but we'll go into details about that and break down those numbers even more later on. ADP did state that the Fed's tightening is starting to have an effect on job creation and pay increases, which is a good sign because that signals that we probably don't have a wage price spiral on hand. You know, we've had many different indicators that has shown that we probably don't have that, but it's always good to get more and more indications of that because if we did have a wage price spiral on our hands, then we would have a Fed that would be very nasty and very aggressive, kind of like they've been for most of this year, but even worse, probably. So, breaking down data, in good producing industries, we lost about 86,000 jobs. And this was headlined by manufacturing, which lost about 100,000 jobs, and construction that lost about 2K jobs. So when it comes to manufacturing, this isn't really any surprise. We are starting to see people spend less money on things and starting to move their spending more to services. Manufacturing, I'm not too surprised about. It's kind of in line with what we saw with the JOLTS report earlier this month as well. Construction, I do expect these these declines to grow as we start to see more and more pain to the real estate market. One of the things you gotta realize about real estate is that a lot of the pain, it takes a while for the pain to bake into the real estate market, especially since most of this pain is coming from higher interest rates. Now, we have seen the 10-year treasury decline over the past couple of weeks. I believe right now it's around 3.6%, and I believe its all-time high was around four and a quarter. So it is a pretty substantial decline, but it still will cause some pain to the it will still cause pain to the real estate market in the long term. So moving on to service producing goods, we actually saw a gain of about 213,000 jobs, and that was headlined by leisure and hospitality, which had a gain of about 224,000 jobs. Again, very similar trend to what we saw in the JOLTS report from last month. When it comes to another sector that also headlined the service producing job gains was trade, transportation, and utilities, which gained about 62,000 jobs this month, which again, very similar to what we saw with the JOLTS report, as well as we saw a decline of 77,000 professional and business services jobs and 34,000 financial activities jobs as well. Again, very in line with the trends that we saw from the last JOLTS report. So, breaking it down by business sizes, most of the layoff came from both small and large firms. And generally speaking, most professional and business services firms are usually smaller firms. These are kind of like you can almost kind of put them in the category of like accountants and like lawyers, engineers, that kind of space. So it's usually companies, because with those professions, you usually don't get increased profit through scale. Usually usually those businesses are usually served for very small for very small headcount, and they don't really get the economy of scales that you would get in like maybe manufacturing, which would be more of a larger firm. Most of the job gains did come from mid-sized firms. So typically, this usually encompasses restaurants and a lot of like leisure and hospitality type businesses. So it does make sense that we saw the job gains with the mid-sized firms. And also, these mid-sized firms usually have a lot of part-time employees, so their headcount tends to be higher naturally because they're operating for like 12, 15 hours a day, and they're operating with part-time employees for the most part. So some of the interesting data I saw on the report is that they actually did a comparison of people who stayed at their job versus people who changed their jobs and the corresponding pay increases. So for people who stayed at their job, their pay went up about 7.6% year over year, whereas the people who changed their jobs almost doubled that at 15.1% increase year over year. And I think that this goes to show you, kind of from a personal finance perspective, how important it is for you to change your jobs every so often. Because if you don't, you usually get left behind on the pay scale. So that's something good to keep in mind. Some other interesting data I saw was that by industry, pay in leisure and hospitality is up about 10.8% year over year, which makes sense because there is more demand for workers in that field. So, of course, the wages would go up accordingly. But when we look at construction, professional and business services, and other service industries, we only see an increase of 6.8% year over year, which is, again, in line with the job growth because we did actually see a reduction of job growth in those industries. So, to conclude, this is mostly these trends that we're seeing in this ADP job report is very in line with what we saw from the October JOLTS report. We will begin, like I said, we will begin those JOLTS reports for November on Friday, and that will really be. And like I said, this sometimes is in line with the JOLTS report. So if we do get a good JOLTS report, that could be a really good case for the Federal Reserve to slow down their aggressiveness, or I should say the FOMC, to slow down their aggressiveness and to kind of stay in the restrictive mode, but not necessarily relax yet. So that's pretty much all I have for you guys. Thank you so much for watching, and I'll see you in the next video.